Thanks for joining me, everyone. It is Thursday, April 16th, 2020. We just had some headlines come out in the markets, and we are currently trading at about 28.73 on the S&P futures. I just wanted to take a couple minutes and I wanted to kind of talk about some of the things that just took place, and kind of give you a little bit of thought process for how I'm looking at things and kind of just revisit some of the thoughts that were given over the weekend and in previous podcasts. If you haven't heard the previous episodes or you haven't checked out the previous video and you want to see what it is that I'm referencing, please check it out on my YouTube at Every Time I Cash or on my podcast channel. You'll be able to see and hear some of the things that I was thinking and kind of see exactly what it is that is going on and where we are today versus what it was that I said on Sunday. If you did check out the last episode on YouTube in particular, you see that I have in front of me this rising wedge that was outlined, and you are just kind of getting a first-hand glimpse of how it's playing out. Really long story short, we have this rising wedge, and this is just the hourly version. So you've got this hourly rising wedge pattern along that pattern since April 6th. We've been in this slow and steady grind higher on this trend. It's outlined in blue, and we've formed a little bit of a wedge from the high that we set on the 14th of April at 3 p.m. We've been this like little down sell wave, and we've been forming this wedge that finally popped just after the market closed today. And we've gotten a little bit of news, and we've gotten a few catalysts here that give us the quote unquote reason why we started to pop. First and foremost, I want to say that news often is a function of what's taking place. It's not necessarily the reason why something is taking place. And when it comes to what was going on in the market in particular, and why it was that we went as far low as we did, and why it was that we shut down the economy and everything else, currently the viral news is going to be more important than the economic news. So we got jobs numbers today, and we're getting earnings left and right. By and large, the jobs numbers are going to be bad, and by and large, the earnings numbers are going to be bad. Basically, Wall Street investors and just traders, everybody participating in general, is kind of giving the market a little bit of a pass, saying that this exogenous event that took place is something that was beyond the control of the markets. And given that the Fed stepped in and decided to create the liquidity that was necessary and started buying anything and everything, including junk bonds last week, we reached a point where the news on the economy doesn't really matter as much as the news on the virus, right? So the important thing to watch moving forward in the short run to intermediate run is a couple things. One, you want to see that when they open up the economy, which they just kind of outlined some sort of plan about opening up the economy, first and foremost, they're talking about it like it's over, it's done with, it's some sort of victory. It kind of reminds me of like when George Bush had his mission accomplished banner and gave a press conference. It's first and foremost like it's not over, right? So this idea that we're winning and we're reopening it, it's a nice little political statement. It's a nice little thing that you put out there so that people feel like you are actually working. But in general, it's not over. But that said, it doesn't mean that it's as bad today as it was a week ago, as it was 2 weeks ago, et cetera, et cetera. It can be, and it can be worse moving forward. We just don't know yet. But currently, there seems to be some progress on Gilead's front with their drug, and there seems to be some sort of breakthrough with the drug. That could be a thing. It could be just a small sample size. We don't know yet. But currently, it seems as though there is some sort of progress that's being made there. Secondly, it seems as though there is some sort of coordinated map of what's going to happen and how things are going to start opening back up. So it's very important to know when this seems to be the case that the viral data moving forward is going to be more important than the economic data. So what you want to see is you want to see the number of deaths per case go down. You want to see that there is no additional stress being placed on the hospital system. You want to see that if you really want to look into it, there's virus thermometer data that is available online. So there are these thermometers that are digital and that sync and display the results online. And if you just pull up one of these maps, you'll be able to see and track the progress of the viral data through reading the number of people that are having high temperatures, for example. So if you start to see things like that slow down, it's going to be viewed as market positive. And essentially, what we decided to do to handle this situation was to throw so much money at it to basically say there's this giant hole that just opened up in front of us on a path that we were walking down. And this hole is really, really deep, and it's creating a really, really difficult way. It's creating a really, really, really big difficulty for us to get across this hole. Like we can't go around it. We definitely can't go through it. We can't go over it. So how are we going to be able to get across from this side to the other side? And what we've decided to do is we've decided to build a bridge with money to get us to the other side. And as long as the virus doesn't come back around, meaning there's this belief that in the summer it'll slow down and then things will get better as we get through the summer, and we'll be able to move through it. So as long as we're not going to be caught off sides on the back end of that, meaning that there will be a resurgence in cases, a resurgence in deaths, and no cure, the market will continue to grind higher simply because, hey, we've thrown so much money at it that the credit risk that was in the market has been stemmed by the Fed and by their buying, and this belief that the economy will pick back up. Now, there's another shoe that could potentially drop that is not necessarily virus related in terms of health, but virus related in terms of shockwave. So in particular, there's this belief that things will go back to normal if consumer habits have been formed during this time and the consumer comes back with sizably more debt than they had, and they need to offset that debt by working more to pay down their debt and to pay down the bills that they picked up during this time. Then this belief that things will pick up as they were may not occur. If rules go in place, and there definitely will be rules that go in place, just like 9/11. When 9/11 happened, they started to build different mechanisms for travel. Like you started to need to have your ID. You started to need to have metal detectors. You had to go through added security. You had to go through TSA. There were certain people couldn't go past certain lines. I remember when I was a kid and I would fly, I'd be able to just fly, and my parents would walk me to the gate, and then they'd turn around and they'd go home, and I'd get on the flight. And then after 9/11, that changed. So just like things like that happen after 9/11, you're going to have to expect that certain things are going to change. The second thing is Trump just said during his press conference, and I was reading notes earlier, that they're going to do it. They're going to open it back up in phases. And I don't necessarily know what that means because I haven't read all of the details yet. But if they're giving local governance, or they're giving local governments the ability to govern and decide things on a case-by-case basis, then the idea that the economy is going to open up will slow down as well. So these are things to keep in mind moving forward, and this will help you, and it helps me kind of keep things in perspective and not get too far off sides on the long side and not too far off sides on the short side. Add to that the idea that things like sporting events and concerts and restaurants and all these recreational consumption driven events and businesses, which make up a real strong point of the economy because it's a consumer driven economy. Those things are going to change. I don't know how they're going to change. You don't know how they're going to change. And we just need to see how they will change and understand how they will change before we can make some sort of clear view on what it is that reopening the economy means and what it is that it means moving forward for the market and for the economy in general. So with that said, I just wanted to show a few charts, kind of walk you through my logic, kind of give you an idea of what it is that I'm looking at and some of the things that you can use to your advantage when trading this mess. So first and foremost, we have that wedge. It's this is your daily wedge on the ES. Currently, like I said, we had this. Let me pull the hourly back up again. We had this wedge being formed on the hourly. Here's your headline. It's outlined by this red arrow. We miraculously had a headline that came out after hours. Always happens that way. Always seems like someone else is profiting with calls, et cetera, et cetera. So you had several headlines. You had Gilead, you had Boeing, you had Apple, you had mRNA, you had the economy in general, right? So first and foremost, it's important to try to play things from a standpoint of trying to understand where the risk is and what your potential outcome can be moving forward. So for me, first place I'm going to look is Boeing. Boeing said they're going to open up some of their manufacturing practices starting next week. You've had this really solid downtrend that started on the 26th of March, and we've been in this downtrend ever since. Every time we've hit it, we've rejected. We just got that headline. There was some call volume on Boeing today. I know a lot of people put a lot of stock into call volume and wise guy activity. I'm not one of those people. I found statistically that it's an inferior tool to trade around and that it's a good tool to have, but it's not a necessary and a primary functioning tool to have, at least for me. For some other people, maybe it could work. For me, it doesn't. But you've got this downtrend. What I'm going to want to see out of Boeing, personally, I'm going to want to see the 5-day and the 20-day hold to the upside. If we break out, I think last I checked, it was around trading around 146. So there is going to be a solid potential that we test this downtrend. If we break out above this downtrend, then essentially, I'm going to draw it out for you. Essentially, the downtrend will come, give you an opportunity to go to this 149, 150 level. If we break above that and we hold that level, I'm looking at 154, 155, and then 157, and then it becomes 160, 163, and then you just kind of draw the lines and move it one line to the next, to the next, to the next, and see how it trades. So that's one that I'm keeping my eyes on. Apple is another one, given that it has a headline. Apple has been digesting for the last 3 days. It's been in this range between 288 and that 550 crossover is taking place at around 280. Essentially, if Apple breaks out of this range, I'm looking for a potential gap fill from this little gap that was placed, and that sets you up for approximately 292 to the upside. If it gets aggressive, it could go, call it 295. And that is another trade that I'll look at. Another one that I'm paying attention to will be Tesla. Tesla has been, again, in this range. Today we ended up buying Tesla towards the lows, which were right around the lows that were set yesterday. We bought it around 710. I just flipped it. I'm not holding any Tesla currently, but I want to see how it behaves at the 780 level. If it holds the 780 level, it provides an opportunity for another 800 test. And then it's anybody's guess how far they push this thing, because as you saw with Amazon and Netflix, when people get off sides, things really get accelerative to the upside. Let me just pull up another one for you. Another one will be all of these health insurers. The health insurers today saw some pretty aggressive buying, I thought, throughout the day. They were bought. Cigna was one that I looked at. I couldn't really find a spread to leverage it. It's a really solid common stock trader. I couldn't find one that was viable on an option front. This is another sector that I'll look at. Another one will be the XBI. XBI has been giving you a really clear setup here with the 87 level. If we break out above the 87 level, we find ourselves in this gap that could get all the way to 89.90, call it. With XBI today having closed back above its 200, having tested its 50, and having tested its 5, and it's holding. So it'll provide 3 levels of support on a moving average basis. Outside of these stocks, and these sectors, I'm looking for setups like this. This is Smile Direct. Smile Direct's giving you a range that it's traded in since March 12th. We've had this range with $6 being on the high water mark, and then you can call it 3.5 or 3.6 on the low side. And essentially, it is drying up in volume and coming up against this longer term downtrend. If we end up breaking through this downtrend, it will set up a potential opportunity to retest 6, and if it really gets aggressive, it could go all the way to 650 and then get as high as, I don't know, 7.5. Depends on how far they want to take it. These are my favorite kinds of trades in a market like this because you can really leverage them. They're really low floats and they can really get accelerative pretty quickly, and they set up for pretty good risk reward. I'm going to show you an example of one that we've been trading for the last couple of days. It was blue. This is an example of how something like that will play out if it plays out in your favor. So with blue, we had 40 to the downside was about, call it 40, was the absolute low. We had this 48 level that was going to function as resistance, and then we had a breakout of this downtrend, a test and hold of the 5 and 20. Once it tested and held, created more room to the upside. Now, it's really important to know that some sectors have outperformed and that money rotates, right? So the one that has been outperforming and currently looks like it is outperforming to the upside on a daily breakout of this rising wedge has been the NASDAQ, and in this case it's NASDAQ futures. We'll see how it performs and we'll see how it trades. It's definitely been an outperformer. A lot of that trade has been Amazon and Netflix this week, primarily Amazon. So a lot of that trade's been Amazon, and with that in mind, I'll want to look to sectors and to stocks that have not performed personally or have performed but have not broken out, and look to leverage those sorts of things. It's really important during markets like this to understand that we're going to be news driven. It's really important to understand what sort of news you want to look for, and it's really important to understand that sentiment a lot of times will drive these things. And just like we got extended on the downside, we can get extended on the upside. We can get ahead of ourselves on the upside, and it's really important to keep yourself in check and in line with those things. So for me, I'm looking for certain trades. Like I said, Boeing was one of them. I'm looking for a certain understanding that just like we had a 14 RSI on a weekly basis on the downside, and just like we had a move that was 2 standard deviations greater than our historical average on the downside in a very short period of time, we can really exacerbate the move higher, and then we can get earnings season where everyone's just saying, oh, it's not going to be a big deal, and then have another shoe drop, midsummer, a couple weeks from now, a quarter from now, who knows, right? So it's really important to keep your mind in that thought process. It's really important to understand these things, and it's really important to allow yourself an opportunity for a margin of error. So for me, like I said, we have the futures, we have the ES, we have a very defined range. Currently now we're going to be testing the 50-day, which is highlighted by this arrow, and then we have a little bit of room to test the top of this rising wedge. If we break out to the upside, we then want to look for this 150-day, which comes out to about 29.45. Above that, we're looking at 3,000 and the 200-day. Whether or not we get there is anybody's guess. Whether or not some sort of headline comes out that makes things worse in the near to midterm is anybody's guess. but it seems as though the pain trade is higher, that investors and traders are not. Everybody was waiting for that retest, and I was one of those people initially. And with the Fed stepping in, basically buying everything, we're basically putting in a potential bottom and saying, hey, here's to hoping that the worst is behind us and that we can kind of move forward. So hopefully this was helpful. Hopefully it was a little bit more helpful than putting up charts and trying to give you some commentary in between. If you like this, please like, comment, share, subscribe. Please leave me your comments below. If you have any questions, comments, concerns, you can always reach out to me. Or if you just want to cuss me up per usual, you can reach out to me at everytimeicash on social media or everytimeicash.com/contact. Thanks for your time. Stay profitable, stay solvent, don't get ahead of yourselves, and until next time, take care.